Meet Jane. Like you, she's an accounting student. Like you, Jane struggles with adjusting entries. But don't worry, accounting gurus are here to help you and Jane. Also called as adjusting journal entries are journal entries made at the end of a period to correct accounts before the financial statements are prepared. This is the fourth step in the accounting cycle. Adjusting entries are most commonly used in accordance with the matching principle to match revenue and expenses in the period in which they occur. There are 4 scenarios where adjusting entries are recorded. First is prepaid expense, costs have been paid but not yet used up. Second, on-end revenue, money has been taken out but service goods have not yet been provided. Third is accrual revenue, revenue is earned but not yet collected. And fourth is accrual expenses, where expenses occurred but not yet paid. Let's look at this example for prepaid expense. At October 31st, 2018, Jane paid for her house rent for the next 2 years for $20,000, and it is now October 31st, 2019, and she needs to make her journal entry. So for the date, she will record October 31st, 2019. In this case, expense will be debited and rent will be credited, as we've already used 1 year's worth of rent and 1 year is still pending. We will record $10,000 as that's what has been spent in the 1 year that she's paid $20,000 for. Let's look at an example of unearned revenue. At the beginning of July, Jane already received $5,000 for photography services scheduled on New Year's Eve, which is 31st December. On her journal entry, she records for July 1st. In this case, Jane would debit the cash and credit unearned revenue. As she's receiving the cash, she would debit it as money is coming into her account, but unearned revenue is considered a liability as she has yet to provide the services, with $5,000 being recorded for both debit and credit account. Now let's look at an example for accrual revenue. On September 1st, Jane bills a customer $8,000 for doing photography at their wedding. Jane's journal entries will start off with the date September 1st. In this instance, Jane will debit accounts receivable and credit service revenue as the service has been provided but cash hasn't been received yet. She will record $8,000 for both debit and credit accounts. Look at an example of accrual expense. Jane has received an electricity bill of $250 in November to be paid by the end of the year. Her journal entry consists of the date starting off with November 31st. In this instance, electricity expense will be debited and accounts payable will be credited. As we've been billed, we will record expense as debit, and as we've not yet paid, we will record accounts payable as credit with $250. Jane is now on her way to become an accountant, and I hope you guys are